Welcome to our Financial Statement Analysis course. Financial statement analysis involves reviewing a company's financial statements, such as the income statement, balance sheet, and cash flow statement, to assess its financial performance and health. The process typically includes the following steps, which we will cover in this course. 1. Review the company's financial statements and related notes. 2. Calculate key financial ratios, such as liquidity ratios, profitability ratios, and debt ratios. 3. Compare the company's financial performance and position to industry averages and/or prior periods. 4. Identify any trends or significant changes in the financial statements. 5. Interpret the results of the analysis and draw conclusions about the company's financial performance and health. 6. Use this information to make informed investment or credit decisions. It's also important to have a good understanding of accounting principles and financial concepts. These will be covered in this course. First, we will start off with an income statement, also known as a profit and loss statement. It is a financial document that shows a company's revenues, costs, and expenses over a specific period of time, such as a quarter or a year. The income statement is used to calculate a company's net income, which is equal to revenues minus expenses. The net income is also known as the bottom line of the income statement. The income statement is typically divided into two sections, revenues and expenses. Revenues are the amounts earned by the company from its operations and are usually listed first on the income statement. Expenses are the costs incurred by the company in order to generate those revenues and are usually listed below the revenues. The difference between revenues and expenses is the net income, which can be either a profit or a loss. The income statement provides valuable information about a company's financial performance and can help investors, creditors, and managers evaluate the company's profitability and efficiency. It can be used in conjunction with other financial statements, such as the balance sheet and cash flow statement, to gain a comprehensive understanding of a company's financial position and performance. Next, the balance sheet is a financial statement that shows a company's assets, liabilities, and equity at a specific point in time, usually at the end of a quarter or a year. The balance sheet is called a balanced sheet because the assets of the company must balance with the liabilities and equity of the company. The balance sheet is divided into two sections, assets and liabilities plus equity. 1. Assets are the resources owned by the company, such as cash, investments, inventory, and property, that have monetary value and are expected to provide future economic benefits. 2. Liabilities are the obligations of the company, such as loans and accounts payable, that are expected to be settled by the company using assets or services. 3. Equity represents the residual interest in the assets of the company after liabilities are deducted, often referred to as the net assets or shareholders' equity. The balance sheet provides a snapshot of a company's financial position at a specific point in time, and gives an idea of how much of the company is financed by debt and how much by equity. It can be used in conjunction with other financial statements, such as the income statement and cash flow statement, to gain a comprehensive understanding of a company's financial position and performance. The third financial statement is the statement of cash flows, also known as the cash flow statement. It is a financial statement that shows the cash inflows and outflows of a company over a specific period of time, such as a quarter or a year. The statement of cash flows is used to track a company's cash balance over time and to understand how and where cash is being generated or used. The statement of cash flows is divided into three sections: cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. 1. Cash flows from operating activities reflect the cash generated or used by the company from its main revenue-generating activities, such as selling goods or services. 2. Cash flows from investing activities reflect the cash generated or used by the company from its investments in long-term assets, such as property, plant, and equipment, or in securities. 3. Cash flows from financing activities reflect the cash generated or used by the company from obtaining or repaying debt and from issuing or repurchasing equity. The statement of cash flows is important because it shows the cash available to a company to pay its bills, invest in new opportunities, and distribute to its shareholders. It can be used in conjunction with other financial statements, such as the income statement and balance sheet, to gain a comprehensive understanding of a company's financial position and performance.